So you're eyeing the real estate market, considering buying a home, but you're hearing lots of different things about interest rates. You don't quite know how to plan for that. This is the video for you. My name is Phil Wells, your no BS real estate agent here in Spokane and Coeur d'Alene. I cut through the hype and just give you the straight facts that you need to know to be, in this case, an informed home buyer. In this video, we're going to break down what the predictions are showing over the next 18 months. So from now until early 2027. We're going to cover rate predictions, housing price predictions, and of course the big one, whether it actually pays off to wait for lower rates. No fluff, just the information you need to decide. Let's get into it. Let's start with the basics. Interest rates drive a lot of buyer decisions. That's no mystery and that's no secret. So what do the predictions look like for the future of interest rates over the next 18 months? Well, looking at various credible sources, for example, the Mortgage Bankers Association, Fannie Mae, and others point to a gradual decline, but they're not going to hit a cliff anytime soon and drop back down to 3 to 4% like they were during the COVID pandemic. All of this is going to be influenced by Federal Reserve policy, things like inflation, jobs numbers, and the overall economy too. And like I said, we're just not heading back to 3%, 4% rates like we saw in 2020, 2021 and during the pandemic. I honestly think that ship has sailed. Mortgage rates aren't the only factor affecting your buying decision though. Home prices are a big factor as well. Predictions on home prices over the next 18 months vary, but many analysts are predicting gains, with only a few predicting some declines. Fannie Mae, for example, predicts home prices will rise 2.8% in this year, 2025, with a more modest 1.1% in 2026. The Mortgage Bankers Association predicts 1.3% growth in 2025, and just a 0.3% growth rate in 2026. And JP Morgan are predicting 3% growth this year. So a range of analysis there, but all within a pretty similar range. Overall, it points to the fact prices aren't going to crash anytime soon. They're going to narrowly edge ahead for the next year or two. So the big question, should you wait for mortgage rates to drop before buying? And what does that decision-making process actually look like? Lower rates typically means lower payments, but it's not that cut and dry because prices and other costs keep going up. Let's run the numbers really quick on a $400,000 home. Today's mortgage rates are 6.5%. That boils down to a principal and interest payment of $2,528. That's excluding taxes and insurance. Now let's wait 18 months. Mortgage rates are 6%, but home prices have increased 2%. So that $400,000 home is now worth $408,000. And your principal and interest payment is $2,445. That's $83 less per month than if you were to buy today. Now, in the model where prices stay flat, your $400,000 home with a 6% mortgage rate comes out to a principal and interest payment of $2,398 a month, which is a saving of $130 versus buying now at 6.5% rates. But if home prices increase 3%, then your savings shrink or disappear entirely. Remember too, it's not just rates and prices you've got to factor into this analysis. You've also got to think about the rent that you're paying while you're not owning, the equity that you're not building, the tax advantages you're not availing yourself of. The bottom line is, small mortgage rate drops might not offset price increases and opportunity costs. If you are planning on waiting for the right mortgage rate, define your strike rate. That's the specific mortgage rate where it makes sense for you to actually move into the real estate market and purchase. Or maybe you've already purchased and you're refinancing. Maybe it's 6%, maybe it's 5.75%, 5.5%. Whatever that mortgage rate is, define that strike rate. But here's the reality if you are choosing to wait. When mortgage rates drop, it's not just you that benefits. Other buyers jump into the market too, and competition increases. Bidding wars increase, inventory becomes scarcer, and as demand surges, prices naturally rise. In past low interest rate environments, we saw markets where multiple offers were the norm, People were bidding over asking and depleting their savings to pay for things like appraisal gap. So if your strike rate is too low, you may end up entering a market that's hotter than you think, and it may erode your savings. So track current rates and set a realistic threshold. Don't chase that unrealistic mortgage rate that may never come. So what's the plan? Here is your no-nonsense checklist. First, sort out your finances early. Check your credit, save for a down payment. 20% is ideal. I know everybody's saying you can purchase a home with only 5 or 10% down, but avoiding PMI by paying 20% down will save you money on a monthly basis. And of course, get pre-approved. This allows you to move quickly when you need to. Number 2, track rates, but don't fixate. Don't become obsessed with these. There's several apps out there that you can set up weekly alerts, monthly alerts, whatever it is. If you're already working with a lender, have them set up a strike rate for you so that they can email you when that rate is either approaching or has already hit. Number 3, team up with a solid local agent that can help you out, help you walk through different strategies, and maybe even run some numbers to see what payments actually look like, in conjunction with a lender, of course, who knows a little bit more about this sort of stuff. Number 4, explore the idea of refinancing. The option to buy now and refinance later is still a good option. You can get way more favorable terms now and refinance that in the future, versus facing that high competition market that I outlined before when mortgage rates do eventually come back down to where other buyers flood the market. Finally, number 5 on this checklist, consider broadening your options. Consider up-and-coming areas, consider fixer-uppers, even consider adjustable rate mortgages or mortgage rate buy-downs if you're not going to be staying too long. But weigh these risks carefully. This approach keeps you flexible, no matter how rates actually play out, because really nobody knows what mortgage rates are going to do. That's it. That's the straight talk on what you as a buyer should be doing, or at least thinking about over the next 18 months. Weigh the pros and cons based on your unique situation. There is no one-size-fits-all approach when it comes to buying a home. If you have questions, comment below or contact me direct. Like this video if it was helpful, and subscribe for further real estate breakdowns and guides. I'll catch you in the next one. Like I said, my name is Phil Wells, and thank you for watching.